We're back with you now on Wave Listens Live with Warren Wealth Management and Tax Planning. They help with retirement and tax planning. They help families and retirees with all aspects of retirement, such as income planning, investment management, insurance, and taxes. So here to walk us through all of it, including some of the mistakes that people make along the way, Marcus Warren, EA, MBA, and tax and financial planner. Good to have you back.
Good to be here. Good to be back.
Okay, we mentioned there's, what, 6 of these that people sometimes fall prey to?
Yeah, so what we generally see, there are generally 6 tax mistakes that people make, in retirement. And so so if we go from 6 to 1, kind of David Letterman style, right? We'll go from 6 all the way to 1. Not a top 10 list, but a top 6 list, all right? Yep. So number 6 is people just ignore taxes altogether. A lot of times when people think about taxes, they think about employment taxes. They're working, they get that W-2, and taxes really continue through retirement, because you're getting Social Security, maybe getting a pension, taking money from your IRA. And it's really important that you don't ignore taxes, because it's going to be one of the biggest expenses that you have in retirement.
Is that something that happens because people, if they've worked a job for, let's say, 40 years, and they're so used to that just being handled by their employer, comes out of their paycheck, that's kind of how you fall into that trap?
That's exactly it. A lot of times, you're right. You have that W-2, taxes are handled by your employer, and you really don't think about it. But when you transition to retirement, taxes need to be on the forefront.
Okay, going down the list, number 5 here, not contributing to a Roth IRA or a 401k.
Yeah, so a Roth IRA, Roth 401k, one of my favorite investments. It allows you to put money in tax-free, after-tax money in. It grows tax-deferred. You pull it out tax-free. Of course, the government has limitations on how much you can put in these things, but for the Roth IRA, you can put in $7,000 if you're under 50, $8,000 each year if you're over 50. For a Roth 401k, you can put in $23,000 if you're under 50. And $30,500 if you're over 50. So you can really stuff a lot of money into this tax-free investment that down the line is going to definitely pay off.
And the best thing to do is leave it alone if you can, if you're financially able.
Yes, put it in there, set it, forget it, let it grow tax-free. And your future self will thank you later.
Yeah, set it and forget it. That's good. It's an easy way to remember it. Okay, back down the list, number 4, taking withdrawals in the wrong order.
Yeah, now a lot of people have questions about this, and I talked about this last week. There's different tax buckets. You have your taxable bucket, tax deferred, and tax free. How you pull money from those accounts, it can make a difference on how much money, if your money lasts throughout retirement. And so a lot of people say, okay, should I take from my tax deferred first? Should I take from my tax free? How should I do it? And it really depends on your individual situation. How much Social Security are you receiving? Do you have a pension? How much money do you have in that tax-deferred bucket? What tax bracket are you in? And so the best thing to do is sit down with a good fiduciary advisor, and they can map out your specific plan on how to take those distributions.
Okay, good to know. Moving down, let's do next, Social Security taxation.
Yeah, so a lot of people get upset about the fact that, especially when they find out that their Social Security can be taxed, right? Because they're thinking, wait a minute, well, basically tax putting money in, right? That FICA tax that you pay each and every pay period, you're taxed on the way in, and they're like, wait a minute, Marcus, so I can be taxed on the way out? And the answer is most likely yes, and it all has to do with what the IRS calls provisional income. So what the IRS does is they add up all the income that you have in retirement. Like I was talking about pensions, they'll add rental income, half of your Social Security, any 1099s you get, and they add that all up. And if you're over certain thresholds, up to 85% of someone's Social Security can be taxed. When Social Security first started out, it used to be, none of it used to be taxable. Then they went to about 50% of it can be taxable, and now they're at 85% of it can be taxable. So when you do progress into retirement, you have to be cognizant and know that that Social Security check that you're getting, up to 85% of it can go to Uncle Sam.
And sadly, not even a surprise anymore, because people are paying taxes on even selling things on apps and things that they used to not have to do before. So it shouldn't come as a surprise anymore, sadly, that more than likely anything like this is going to be taxed.
Yes, Uncle Sam wants his cut.
Yeah, he's going to get it too. Okay, we've still got 2 more of these to go. Number 5 is next, assuming taxes will be lower in retirement.
Yeah, so a lot of times when, really, we've just been told, hey, when you retire, you're going to be in a lower tax bracket. That's not generally the case. A lot of times you end up paying more taxes because a lot of your deductions go away. And so what a lot of people find out once they're in retirement, that they're paying just as much, if not even higher taxes once they're retired. So you have to make sure that you have a plan going into retirement on how to deal with that.
Okay, and then the number one mistake that people make, and I imagine this is probably the number one mistake we make even before retirement, is having no strategy in place to minimize our taxes.
Yep, and so the number one tax mistakes that people make that ruin their retirement is not having a strategy. You have to have a plan, right? You have to make sure that you deal with these taxes moving forward. Number one, right now we are in the lowest tax environment that we've seen pretty much in our lifetime. Unfortunately, these tax cuts, they expire at the end of 2025. So taxes are going to go up going into 2026. And if people don't plan for that or have a strategy for that, especially those who are in retirement and have these tax deferred accounts, you're going to find yourself paying a lot more in tax than you ever planned for.
And if you have multiple of these mistakes on this list, you're probably going to get hit multiple different ways. And that's when having no strategy probably really is a rough one for you.
You're right. You're right.
Okay, about 30 seconds left. This is great information. If people want to get in touch with you guys and have you help out and map out that strategy and get rolling on this, what's the best way to do that?
So the best way to do that is to go to warrenwealth.net. There, once you go to that site, you'll see, number one, you'll be able to calculate how big your retirement tax bill will be. I would highly recommend people do that. And then you can scroll down a little bit, and then you'll find a little spot for you to schedule a 15-minute phone call with me, and we can find out if we're a good fit and see if we can help you.
Easy enough. Well, Marcus, always good to see you. Thanks for the tips.
Appreciate it. Thank you.
All right. Stay with us here on Wave Listens Live. One more segment to go. Gilda's Club Kentuckiana is joining us coming up next.